On 16 July 2001, the Eicher Motors stock traded at just 2 rupees. As of 16 July 2024, it's worth 4,885 rupees. So, if you had invested 10,000 rupees in Eicher in 2001, your investment today would be worth over 2.44 crore. That's an annualized return of 40.5% as against the Sensex 14.7 and the BSE Autos 22.4. Brilliant, isn't it? But things always look simple and easy in hindsight. Back in 2001, you had to be either a genius or a lunatic to have bought Eicher. The company had been loss-making, had over-diversified itself into 15 businesses, and was actually toying with the idea of shutting down its Royal Enfield division, which later turned out to be its crown jewel. Fortunately for Eicher, by that time, the man who scripted the company's turnaround had joined it. Siddharth Lal was only 26 when he became the CEO of the Royal Enfield division of Eicher Motors in 2000. In 2006, as the CEO and MD of Eicher, he decided to liquidate 13 of the 15 businesses Eicher was present in and decided to focus just on Royal Enfield and trucks. The rest is history. But why are we talking about Eicher Motors today? Because Eicher is a classic example of turnaround. Now, the magic of investing in a turnaround stock is that if you get it right and if you stick to it through the years, you will never have to worry about returns. Companies that turn around often see their stocks skyrocket. So, turnaround investing is a highly profitable style of stock investing. Of course, it's not that easy. That's because there are no predefined formula for picking turnaround stocks. But there are certain signs that one can look for. And that's what we will talk about in this video. We will also give you a list of stocks that exhibit these turnaround signs so that you can research them further. Hello and welcome to ET Money's YouTube channel. Today we are talking about how you can go about spotting turnaround companies. However, do know that this framework or the stocks aren't our recommendations. When we talk about stocks or give you a list, we don't intend to recommend them. They are meant to serve as examples or as the starting point for further research. So don't miss to do your own due diligence. Alright, before I start, let me ask you to subscribe to this channel if you aren't already a subscriber. And do press the bell icon so you never miss a video from us. Alright, let's begin with the first sign of turnaround stocks. This is the simplest metric to start your hunt for turnaround stocks. Here, you look for stocks that have fallen over a period of time, say 1 year or 3 years or 5 years, or that have underperformed the market or an index for an extended period. You can also look for stocks that are at historical lows, such as 52 weeks, 3 years, 5 years, or even all time. Now, the idea is to have a short list of stocks that are possibly in some kind of trouble at the moment. And the logic is simple. These stocks may be ripe for a turnaround. For instance, when we looked for stocks that have corrected by 25% or more over the last 1 year within the BSE 500 group of stocks, 3 names came up. Of course, you can decide the thresholds as per your preference. If we consider stocks that have delivered a negative return over the last 1 year, when the BSE 500 itself went up by 37.7%, there are as many as 49 names. So that's quite some number for a research universe. Whatever shortlisting criteria you take, be prepared to dig deeper. For instance, let's take 197 Communication, which is known to us as Paytm. The Paytm stock crashed by about 46% over the last 1 year as the RBI imposed curbs on Paytm Payments Bank on grounds of non-compliance. From its IPO issue price of 2,150 in November 2021, the stock has corrected to 460, a fall of about 79%. The company is yet to turn a profit and has also been loss-making at the operating level. So, on the face of it, it appears to be a tough journey towards profits and consequently a turnaround for Paytm. But we are not asking you to buy or discard Paytm. This is how you should start looking at the companies in your shortlist. Check why these companies are suffering. Are the reasons temporary or are they more structural in nature? Check the company's financial track record. Read up the annual reports to assess where the company may be headed and what plans the management has for a turnaround. With the help of all this information, try to assess how likely a company's turnaround is, and based on that, you can invest in it. Alright, now let's talk about the next metric to spot turnaround stocks. this is the classic method to spot a turnaround stock. Here, you look for companies that have recently turned a profit after years of losses. For instance, when we looked for companies that turned profitable recently after 3 years of losses, we found 20 names that have a market cap of over 1000 crores. Since these companies have recently turned profitable, they could very well be on the path to a turnaround. Here, we have considered yearly numbers. If you would like to, you can also check quarterly data for these signs of return to profitability. But again, do dig deeper to know how promising their turnaround prospects are. For instance, if the profits are due to an exception or an extraordinary item, that can't be taken as a turnaround cue. So, check their financials, read their annual reports, and management discussion and analysis. Another way to pick prospective turnarounds is to look for companies that are profitable at operating or EBITDA level but are loss-making at the PAT level. Now, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So, these companies already have revenues that can cover their expenses, but due to the interest component, depreciation, and taxes, they are in loss. Now, as these companies solve debt-related problems, they can turn around. It's also worthwhile to note here that depreciation is a non-cash charge, so it doesn't result in an actual cash outgo. So do put it in perspective. Now, here are some companies that have delivered a positive operating profit for the last 3 years, but they have a net loss for the last 3 years. Let's consider Vodafone Idea, an ailing telecom company. Now, Vodafone Idea is profitable at the operational level with an EBITDA of about 17,239 crores. But due to large depreciation and interest charges of about 23,000 crores and 26,000 crore respectively, it is in heavy loss. Now, depreciation may be something that's part and parcel of the business Vodafone is in, but if the company somehow solved its massive debt problem, it is a chance of turning around. There have been reports of equity infusion by promoters, conversion of debt into equity, and asset sale, all of which can help the company turn around. But it remains to be seen if the efforts of the management indeed materialize or if they fail to revive the company. And this is exactly what makes turnaround investing tricky. A related turnaround indicator is when a company has a high operating margin but is loss-making. A high operating margin can often aid a turnaround. Now, here are some companies in the BSE 500 that are loss-making at the PAT level but enjoy operating margins of over 20%. Well, let's now move to the next sign of promising turnaround stocks. For a turnaround to happen, it's not essential that the company in question is loss-making. Even profitable businesses can also witness a turnaround. For a profitable business, a turnaround means an improvement in growth metrics. So, for instance, if a company that has been registering measly or stagnant revenue and profit growth puts the pedal onto the metal, that may be a sign of a turnaround. For instance, let's find out companies in the Nifty 500 whose latest revenue growth is higher than the previous 3-year revenue growth by at least 5 percentage points. Now, 12 companies make the cut here, with HDFC Bank topping the table. But do remember that HDFC Bank's revenue growth is primarily due to its merger with HDFC Limited, so do take that factor into account. Similarly, one can look for companies whose latest operating margins are greater than the average of the last 3 years, say by 3 percentage points. Coal India has registered a massive jump in its operating margin, which has also aided the company's profits. Dr. Reddy's and Bajaj Finance are at the forefront too. You can also use other metrics such as EBITDA growth or profit growth or the change in ROCE to measure growth as well. But again, whatever metrics you choose, do dig deeper to find out the reason for the improvement in the growth metric under consideration. There must be a business reason behind it. Let's now take a look at some other vital indicators of a turnaround. The first is the reduction in debt. High debt can take a toll on the business performance, as we saw in the case of Vodafone Idea. So, when a highly indebted company cuts its debt, that could help in a turnaround. For instance, on your screen are some companies in the BSE 500 whose debt to equity ratio was more 2 until 2 years ago, and now it has come under 1. The second indicator is an improvement in cash flows. Negative cash flows from operations indicate that the company finds it difficult to generate cash from its operations. It may have profits to show, but those profits are not getting converted into cash, possibly because the company has made sales on credit and is finding it difficult to make its buyers pay up. If this keeps happening for a prolonged period, it can snowball into a financial crisis. So, when a company returns to positive operating cash flows from a series of negative ones, that could hint at a turnaround. Now, we looked for companies in the listed space that have reported a positive cash flow from operations after 3 straight years of negative cash flows. 13 companies made it to the list. The third indicator is an improving expenditure to sales ratio. It is derived by dividing the expenditure by revenues. An improvement in this ratio suggests improving efficiency, which can in turn signal a turnaround. For instance, within the BSE 100 group of companies, these companies have reduced their expenditure to sales ratio over the last 3 years. A notable case in this set is Interglobe Aviation. The company's expenditure to sales ratio has fallen from 1.03 to 0.76. Indeed, the company is moving fast on the road to a turnaround. It has posted a profit of 8,172 crore over the last 12 months after 4 straight years of losses. The fourth indicator is a change in the sectoral business cycle. Many sectors, especially commodity-related ones, are heavily dependent on the sectoral business cycle. During the up cycle, their profits go up, and during the down cycle, the profits fall. For instance, consider the operating profit and PAT of Tata Steel for the last 15 years. There have been periods of ups and downs which correspond with the up and down cycles of steel. After a mega up move, the profits have fallen recently. This could suggest a change in the steel cycle. A similar phenomena can be observed in ONGC's profits. On similar lines, there are cycles in real estate, infrastructure, cement, auto, and other sectors. So, one way to profit from the turnaround in these sectors is to invest in them when they are going through a down cycle and exit them during the up cycle. For instance, Tata Steel's chart suggests that the steel down cycle may have started. On the other hand, ONGC's chart hints at an ongoing upcycle for oil. Now, let me admit that this is a rather simplistic interpretation of a sectoral cycle. In reality, it is a much more complex concept. So, use this indicator along with your own research to ascertain if a sector is indeed going through a up or a down cycle. You can read industry reports, interviews with business leaders in these sectors, demand and supply data, etc. to ascertain where a company in the terms of underlying cycle. A related question then is, how do you know if a down cycle has bottomed or the up cycle has stopped? Well, just as you can't know for sure when the market itself has bottomed or peaked, it's nearly impossible to catch the bottom and peak of a cycle. You will have to make educated guesses and buy or sell in a staggered manner to play the cycle. The fifth indicator is a change in management. Quite naturally, when a company's top management or the promoter changes, there are often wholesale change in the company as a new management realigns the business. For instance, take the case of Yes Bank. After a fraud by its co-founder Rana Kapoor came to light in 2018, the Yes Bank stock fell from 394 in August 2018 to just 11 rupees in August 2021. To save the bank, its ownership was handed over to a banking consortium led by SBI. The bank seems to be turning around under its new management, as seen by its improving profitability. Consequently, the stock has recovered to around 22 now and has delivered an annualized return of 23% over the last 3 years. The sixth indicator is a rise in the promoter stake. If promoters are raising stake in their own company, it could signal better prospects for it. On your screen are companies in which promoters have risen their stake over the last 4 quarters. But do know that at times promoters can increase stake in their companies just to pull wool over investors' eyes. So, do assess a company's financials and fundamentals too while using this data. The seventh indicator is asset sale and move to the core competence. Often companies venture out into unrelated areas and then end up with an albatross around their neck. As the management realizes its mistakes, it then corrects its course and refocuses on the core activities while divesting its non-core businesses. When this happens, it may be a sign that a turnaround is underway. At the start of this video, we saw how Eicher exited 13 of its 15 businesses, and that helped the company turn around. Also, when an indebted company resorts to sale of its assets, that also signals the management's intent to turn around the company. A good example of this is Vodafone Idea. So, these were some vital indicators to help spot a turnaround. Let's now quickly see some do's and don'ts of turnaround investing. First, as we discussed on multiple occasions, don't rely on a single indicator to spot a turnaround. The indicator should just be a starting point. Always dig deeper. The more the turnaround signals, the better. Second, turnaround investing is all about being patient and vigilant. After you have spotted a turnaround play, you will have to give it sufficient time. At the same time, regularly check what the company is doing. There are seldom, if ever, any rapid turnarounds. Always expect a turnaround to take more time than anticipated. Simultaneously, don't be discouraged to see the turnaround company temporarily reverting to its past poor performance. Such an occurrence is normal. As an investor, you should be tolerant of it. Third, take a portfolio approach to turnaround investing rather than focusing just a couple of companies. That's because there are high chances of going wrong with turnarounds. There are several examples of companies that suffered and never turned around. Videocon, Punj Lloyd, Reliance ADAG companies, Lanco Infra, DHFL, Jet Airways, and so on. Indeed, it's better to expect that most turnaround plays in your portfolio may fail, and that's okay, because if you can just get a couple of turnarounds right, they can more than compensate for the failed bets. Last but not the least, turnaround investing is a highly sophisticated form of investing. It requires its fair share of time and diligence. If you don't have enough time or can't do the required research or tracking, it's better not to dabble in this investing style. And with this, it's a wrap of the video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.